Hello, everyone, and welcome to this evening's market update. We're very happy to have you all. Um, Please remember you will get this recording sent to you via email tomorrow. If you would like this evening's slides, please be sure to email us and we will be happy to send you these slides. So let's get started. The very first thing is I need to start with some important disclosures. So Triumph Capital Management is an SEC registered firm. As such, we are a fiduciary when working with our clients. This evening, I'll be making some comments about markets, including some future comments about maybe where we see things going. I like to say this, that these forward-looking statements are just that, and they're subject to change. Nobody can predict the future. And I'll make comment of this along the way. In addition to all making forward-looking comments, so on and so forth, inside of here, if I say anything about a market index and so on and so forth, it's fair to say that you can't invest directly into a market index. Often what we'll use is the ETF as opposed to the index, only because you can invest, in the ETF that mimics the index. Also, I should say that all investing involves some level of risk, including losing 100% of your money. Depending upon where you are in that risk spectrum, different risks apply. About myself, most of you know me. My name is Derek Eichenwald. I have the unique pleasure of serving as the CEO of Triumph Capital Management. We are a firm located in Denver, Colorado, with offices up and down the Front Range, as well as in California. Tonight, what we will be talking about is the market and the different market sectors. We'll go through the performance of the markets, both stock and bond. We'll talk about some international markets. I'll give you some perspective and some history on the markets. We'll talk about why markets are selling off. We'll talk about economies and so on and so forth. We'll talk a little bit about the Fed and what they're doing inside of all of this. So, without further ado, let's go ahead and let's break into this. So the first 3 quarters of the year, where are we? As most of you know, markets for the first 3 quarters of the year look absolutely awful. As you can see, the NASDAQ, the tech-heavy NASDAQ, down just about 33% as of the close of business at the end of the third quarter. The Russell 2000, which kind of picks up small and mid-sized publicly traded companies, down 25%. The S&P 500, 500 of America's largest companies, down just shy of 25. And the Dow Jones Industrial, which is 30 of America's largest companies, down just about 21%. It's been a kind of a slow and steady sell-off over the first 9 months of the year, as the chart shows. And these are the returns of the S&P for each month. As you know, in January, we got a very bad month, down 5.26%, as the chart shows. We had CPI come in, and CPI is just the inflation number. That number came out January 12th. We hit 7%. And we also had the Federal Reserve talking about shrinking their balance sheet, which simply means selling off bonds. In February, obviously, we had Russia invade the Ukraine. We saw the market sell off, not as bad as we would have thought. Market was down, just north of 3%. In March, we got an interest rate hike. It was the first interest rate hike since 2018. 2020. We will unpack that a little bit more as we work through tonight's numbers. And then really May, June, July, August, and September were really just concerns about inflation. And we'll unpack inflation. We'll unpack the causes of inflation as we go through tonight's meeting, and I'll unpack these additional months. Again, the S&P as of the close of the quarter, down 24.77. If we go overseas across the pond and we look at developed international, emerging markets, and frontier, as you can see, internationally speaking, not much better. Developed international is going to include most of Europe and those kind of developed countries. Um, Emerging markets, you know, refers to Brazil, Russia, India, China. I should mention Russia is kind of no longer inside of those numbers because the Russian stock market ceased to trade back in March. And so, if you think about it, we've been referring to these markets, these emerging markets, as emerging markets forever. When I say forever, the last 20, 30 years. And so, there's kind of this new emerging market, if you will, called frontier markets. And frontier markets include stock markets such as Vietnam, Nigeria, Romania, Morocco, Bangladesh, Peru, Egypt, so on and so forth. And that's what frontier is, if that's a new term for you. If you notice here, if I break down developed international between the United Kingdom all the way to Australia, you can see the different rates of returns in those countries. And if I look at emerging markets, Brazil, Russia, India, China, so on and so forth, you can see what those countries have done. Interestingly enough, Brazil up 10.5% for the year. Interestingly, Brazil was one of the first countries to raise their interest rate. They did so very early. And Brazil, there's a lot of companies inside of the Brazilian stock market that operate in food and also in energy, two areas that are doing well. One place that investors can hide out inside of is the bond markets. However, this year, bond markets look just as bad as stock markets. Well, you know, not necessarily as bad, but as you can see on the screen, at the close of business for the quarter, you had investment grade bonds down close to 22% for the year. Interestingly, you had high yield or junk bonds down 15. Typically speaking, in a very bad economy, in a very bad recession, you would see junk bonds down a lot more than investment grade bonds. Think of it as two different borrowers, one with a very good credit rating, that one being investment grade bonds, and the other one with not a great credit rating, being that one would represent junk bonds. You can see that US Treasuries are down close to 14%. Treasury inflation protected securities. So again, issued by the government, and supposed to kind of hedge against inflation, down even more than fixed US Treasuries. And municipal bonds down close to 11% for the year. We find this extremely interesting. I'll unpack that a little bit more as we delve into tonight's topics. If we break it down into sectors, the S&P 500 again represents 500 of America's largest stocks. Often people believe that these 500 stocks are equally weighted. They are not. The weights of the S&P 500 are now shown to you in this chart. In other words, technology represents 26.5% of the S&P 500. But if I go and I break down the different sectors of the S&P 500, you notice that communications, those companies would include companies like Facebook and Google, down 38% for the year. Technology companies such as Apple, down 31.21% for the year. Consumer discretionary, we're going to talk more about the consumer discretionary, but down 30% for the year. And I won't read the whole chart to you, but you can see here the different areas. Now, yes, utilities and energy both up for the year, but of course only representing a very small weight inside of the S&P 500 versus what a lot of people kind of consider technology. In that technology space, technology represents nearly 40%. You know, if I combine communications, technology, and some other companies of the S&P 500. If I break down those sectors a little bit more and I just look at industry, so companies that work completely in the internet or semiconductors or software, so on and so forth, you can see what those particular securities are down. You notice internet stocks down 44%, software stocks down 38%, home builders down 36%, so on and so forth. Let me give you some market perspective just to start off. Most of you on tonight's webinar have certainly seen this chart before, but some of you definitely have not. So what you're looking at here is you're looking at the returns of the S&P 500 from 1980 until September 30th, 2022. The gray bars to the upside show you what the S&P 500 did as far as performance in that year. In other words, in 1980, which is the first graph or the first bar on the graph, the S&P 500 was up 26%, as you can see here. If I go back and I look at, 08, you notice that there's a gray bar to the downside showing you market down 38%. Obviously, the gray bars to the downside, as I was saying, that represents what markets, were down any particular year. But now I want you to focus on the red dots. The red dots are simply showing to you what the market was down at one point during that particular year. In other words, if I go back to 1980, just to be easy on the eye, at one point the S&P 500 was down 17%, indicated here by that red dot. However, from January 1st to December 31st, the S&P 500 posted a positive 26% rate of return. What I want to say is that the red dots are the norm, they're not the exception. In fact, for every single year from 1980 until current date, you see a red dot on the graph. What you should also pay attention to is how many more upsides there are than downsides. In fact, if you do the math inside of this, 32 of the 42 years, okay, we've been up, indicating that we've been up 76% of the time. 76% of the time, the S&P 500 posts a positive gain. More importantly, if you will, when we have a down markets are very short-lived. In 1981, the market at one point was down 18%. As you notice, we ended up the year only down 10. However, that was just 1 year. From there until we got into the 90s, we were up 9 years consecutively. Often when we have a down year in the S&P 500, it's followed by multiple consecutive up years. There is an exception to that, and this goes back to the 1999 tech bubble when it bursts. There's a lot of reasons for this. I don't think I'll get into them tonight. If you're interested in discussing it, and I'll make some comments of that 1999 tech bubble burst. This is when I was first getting into the business that I'm in today, and things had really changed with the birth of the internet and what many were referring to as the spark of a new economy. If you think back to 08, 09, one of the worst global financial crises we ever had, at one point the S&P 500 down close to 50%, ending the year down 38, we were only down for 1 year. That 2008, 2009 global financial crisis with multiple companies going out of business. I mean, if you think back, Washington Mutual gone, Merrill Lynch out of business, of course bought by Bank of America, so not out of business, but was going out of business. Goldman Sachs out of business. General Motors out of business if it wasn't for a government bailout, and the list goes on and on and on and on. I mean, it was really, really kind of crazy. Market was only down 1 year. So this is just some perspective to keep in mind. Of course, year to date, as I mentioned earlier, S&P is down 24.77, and that's why you see 25%. In fact, on 9/30 was our absolute low for the year. If we look at bond indexes, again, as I said earlier, bond indexes, down. Same graph, so same information. Gray bars to the upside, gray bars to the downside, and then the red dots. This chart goes all the way back to 1976, and you can see the bond market. And when I say the bond market, in my last slide, I had investment grade bonds and junk bonds, and I had, munis and tips and government bonds. And so what this does, very similar to the S&P 500, is this is what's called the U.S. aggregate bond index. Kind of mixes a lot of those bonds together to give you a good feel of what that whole bond market does. And if you notice here, from 1976 until current date, the red dots again are the rule, not the exception. So intra-year, we've always seen bond markets go down, but as you can notice inside of here, you generally don't have bond markets that end for the year. In fact, if you think of the math here, 42 out of the last 46 years, so 91%, a little north of 91% of the time, the bond market has ended the year in positive territory. Very interestingly, here we are in 2022, and very similar to the stock market, the bond market on September 30th of 2022, the Bloomberg aggregate bond market down 15% for the year, the most it's ever been down since 1976. One thing to remember, we're going to unpack that as to why. We're going to talk about it. We're going to go into it. I'm just kind of starting with, a little bit of a little bit of data. Remember, time is on your side. And so the calculator that I'm using here is offered right at the S&P 500's website. Again, you can't invest directly into the S&P 500, but the website does provide for some wonderful backtracking. And so this is simply saying, hey, if you went back to September 1st, 2012, and you invested $100,000 and just stuck it into the S&P 500, you didn't pay attention to any of the news. In fact, you were in Antarctica. You didn't have a computer, you didn't have a cell phone, you didn't know anything, what was going on in the world, and you landed, okay, back in Denver on September 30th, 2022, 10 years later. And you finally sit in front of your computer, you open up your TD Ameritrade account, and you look at what your balance is. Lo and behold, your balance was 307,000 inside of the S&P. Now remember, that didn't go without ups and downs. In fact, at one point towards the end of 2021, your portfolio kissed very closely to $400,000. But again, ignoring the news, you had an annualized return of 11.88. Of course, that doesn't include taxes, it doesn't include fees, and again, it's investing directly in an index, and there's risk with that. Of course, that was 10 years, so I also ran a quick calculation simply going back 20 years. You invested the same $100,000 September 1st, 2002, Antarctica, on vacation, 20 years, came back September 30th. Sure, the portfolio, as you can see here, almost hit $800,000 just a short 9, 10, 11 months ago. But again, you came in and your portfolio worth $622,000, an annualized return of 9.56. Keep in mind here, market's up 76% of the time. When we have these down opportunities, when we see a market that's down as it is today, it can present opportunity to invest. One graph that I love, it's the consumer confidence reading. And so all the consumer confidence is the University of Michigan. Every single month they go out there and they survey 5,000 households. So it's an example as what they may survey you. You get a call, it's the University of Michigan. Some of you have told me that you've actually received the call, but here's an example of one question that they would ask. Hello, Mr. and Mrs. Johnson. We're interested in how people are getting along financially these days. Would you say that you and your family living there are better or worse off financially than you were a year ago? They take your answer. Then they would say, hey, now looking ahead, do you think that a year from now, you and your family living there will be better off financially, worse off, or just about the same? And essentially, they ask a series of questions and they come up with the Consumer Confidence Index. What this graph does, and again, some of you in the webinar tonight have certainly seen this from us in the past, but what this graph does is it shows you on these blue dots the lowest consumer confidence ratings by these blue dots located at below, and then the blue dots above the blue line show you consumer confidence ratings that were very high. As you notice here, the blue dashed line in the middle that says average 85.6. Okay, the number underneath the reading is telling you what the S&P 500 did for the 12 months after that. In other words, August 1972, which is the first blue dot on the graph here, Very high consumer confidence rating. You had about a 95, which is well above the average of 85. So from August 1972 to August 1973, the S&P 500 was actually down 6.2. Now let's look at February 1975. A very low consumer confidence reading came in at about 58, as you can see here on the graph. However, the S&P 500's rate of return from February 1975 to February 1976, a positive 22%. Interestingly enough, if you let your eye now look at these different dates and you look at the high readings versus the low readings of what the S&P 500 did for the next 12 months, it's quite amazing that you notice that, for instance, May 1980, very low consumer confidence. Oh, we feel awful. Our finances are a mess. We've lost all this money, just to see the market do extremely well over the next 12 months. Well, our latest consumer confidence reading came in at 58. That was in September. Again, well below the average. Now, remember, we actually had the lowest consumer confidence reading in history last month. It was just about 50.6, so just sat on 50. You notice here, September 2022, we don't have a rate of return for what the S&P may do because nobody can predict the future. But it's very interesting to me that the consumer, when they feel the worst, the market generally does well. There's some reasons for that. Maybe we'll unpack them. Very quickly, I said something. We are going to jump into the economy, but I did feel as though I wanted to address this. I put a slide up earlier, and it showed you the bond markets. And I said very interesting. And most people would ask, why is this very interesting? Well, here's why. If you think of a bond, what is a bond? And I think a lot of people don't understand this. Some people may be laughing, like, what do you think? I don't understand what a bond is. But let me explain because it may be eye-opening to you. So all a bond is, it's a company that goes out there and says, hey, we want to borrow some money. And when a company, a big company goes to borrow money, they typically don't go to a bank. They go to the world and they say to the world, hey, we want to borrow $1 billion. And they issue you a bond. And if you buy the bond, bonds are typically sold from the company directly to you for $1,000. On that bond, it says, hey, this piece of paper, this bond pays 5%. Therefore, every 6 months, you would collect $25, $50 a year, 5% against the bond. Let's say you bought this bond in 1920, okay? And the reason why I'm using 1920 is there's no computers or anything. Say you live in the middle of the country and you bought this bond from a company like, I don't know, John Deere or something like that. So you live on a farm. John Deere just opened up. They're looking to borrow money. You go down to John Deere. You say, hey, I want to buy one of those bonds paying 5%. And the nice lady at John Deere hands you this piece of paper and it says John Deere and it's got this beautiful symbol on it. And it would say 5%, and it says, hey, you bought it, January 1st, 1920, and it matures January 1st, 1925, or December 31st, 1925. What this bond would have is it'd have these little perforated pieces of paper on it, right? These little things called coupons. And every 6 months, you would walk down to John Deere, if that's what I used as an example, and you'd hand them one of these coupons. And the nice lady sitting behind the window would hand you $25. Okay. All of a sudden, the 5 years has gone by. There's one little coupon left on your bond. So you head down to John Deere with your whole bond, and it's got the one coupon on. And she says, here's your $1,000 back because your bond matured, plus your last $25 of interest. Pretty easy. Everybody kind of understands that. But now let's kind of make things a bit more complicated. So you bought it in 1920, it's sitting in your safe, your bond, you pick the coupon up. You don't know what the price is for the bond, right? If you want to sell. But let's say only 2 years have gone by. And you walk down to John Deere and you say to the nice lady sitting behind it, hey, listen, this bond's been great, but I just like my $1,000 back and maybe some interest. And the lady behind the window says, hey, we don't do that. We only redeem your bond when it's due, right? Just like anything else. So you knock on your neighbor's door and you say, hey, neighbor, I have this bond from John Deere down. Thing's great. I've owned it for 2 years. You know, every 6 months you get to go down there. They give you 25 bucks. Um, but I need the cash today. I want my $1,000 back. And the lady at John Deere says I can't get it until my bond matures. This isn't until December 31st, 1925. And so your neighbor says, hold on a second. He goes back in his kitchen or whatever. You hear him clanking around. And he comes back out and he says to your neighbor, I'll buy the bond from you, but I can only offer you 700 bucks or 800 bucks. And you say, what the heck? You're going to, if I sell it to you for $800, now you own it. You get to go down there and collect your $25 every 6 months. Plus, in 2025, which is now only 3 years away, because I've owned it for the last two, whoever owns that bond, they're going to give back $1,000. Now, of course, listen, there's risks in bonds. Could the company go out of business? Yes, right? And if the company goes out of business, you might get nothing for your bond. But the reason why I said very interesting, and again, what I'll also say, and I should have said in the disclosures, is nothing that I say tonight is a recommendation for anybody listening to this or watching this. I'm simply explaining conceptually how things kind of work and why the bond market's very interesting. And you know, everybody's financial situation is different, and this is no recommendation to buy or sell a security at all. This morning, I went and I looked at the bond market for tonight's presentation. I was just kind of interested. And so I went out there and I said, what if somebody had 120,000 bucks and they bought 10 bonds of these different companies? So you notice inside of here, Ford, Toll Brothers, Delta, Hilton, whatever. So if somebody had $120,000, as you notice, I don't have a drawing tool, but maybe you can see my mouse. It's saying to you, hey, these bonds, okay, are worth 120 grand. But if you went to go buy them today from your neighbor, as I mentioned earlier, you would only pay for these bonds 104,000. Now let's pretend you're the person who paid the 120 grand for these bonds. You're seeing today, okay, that those bonds are only worth 104. So down, right, about 16, 17%, as I showed you earlier. However, even though they're down, right, in value, that's only if you went to go sell them today. Upon maturity, you'd still get back the $1,000 that you paid for it, assuming the company doesn't go out of business. The reason why I found this so interesting, okay, is that let's say you bought these bonds today for 104,000, they matured for 120, but along the way you were collecting the interest. What that means is that you would end up earning annualized, as you can see here, yield to maturity, about 7.15%. The average maturity of the bonds, so they all have these different maturity dates, as you can see here, like this Ford bond matures June 20th of 2027, so not too many moons from today. And you see other bonds like Credit Suisse maturing May 31st of 2032, so 10 years from today, but you blend all that together, it has an average maturity of 7.4 years. Now check this out with me. This is all the same data I just showed you, but you bought these bonds for 104,000. They mature for 120. Therefore, you have a gain of $15,985. That represents a gain, percentage-wise, of 15.37%. However, remember, you got to wait 7.4 years to kind of realize that. So you take that 15.37 and you divide it by your holding time, the average time, the 7.4 years, and that comes out to 2%. But you're collecting an effective yield of 5.18 because the bond's paying you the interest. And so over that, 7.5 years, you end up earning 7.15%. But check this out. What if the Federal Reserve cuts rates? Now, when I say that to you, I said that to somebody the other day and they started laughing in my face. The Federal Reserve cut rates. By the way, for those of you who have been clients for years, this is exactly what happened in 2008, okay, as far as bonds are concerned. Pretend now that the Fed cuts rates and therefore bond prices go up, and we'll talk about why bond prices are down. And now, instead of waiting for the 7.5 years, The bonds go back to maturity value, so back to $1,000 a piece in 3 short years. So instead of your holding period being 7.5 years, your holding period's only 3 years. All the same data, but now your annualized rate of return over a 3-year period of time, 9.61. Find bonds so interesting today because on the risk scatter plot of things, say you have say, 0 is no risk, 10 is the most risk, say real estate's a 5 in the middle, you put bonds of all different types between that 0 and that 5, depending upon if it's a government bond or a corporate bond or a junk bond or whatever the case may be. So on the risk profile of things, it's kind of interesting. So there's that 9.61. Remember, these types of opportunities typically, they do present themselves, but today with the bond markets being down where they are, aggregately down 15%, it's quite interesting. Now that said, okay, with your money, there's choices of what to do with it. And so when people go into the bond market, so on and so forth, it's nice. It can offer predictable income, but buying bonds at a discount is why that annualized return is much higher than it has been over the last few years. But remember, the market today, just today, okay, S&P posted 92.18 points, up 2.6%. The Russell up 44 points, posted a 2.6% rate of return. The Dow up 765 points, posting a 2.66% rate of return. And the NASDAQ posted a 239% point gain, up 2.2 in one day, okay, in one day. And so markets can perform very well against bonds. It's, again, not a recommendation, just explaining things, okay? So why are markets selling off? Let's jump into it. The first thing, because I talked about bonds, let's say why are bonds selling off? Well, it's quite easy. When interest rates rise, bond prices go down, okay? So if you think about it, when a bond gets issued, as you can see in my little graph here, bond gets issued at $1,000, it's paying 5%. If the Fed increases interest rates and that company goes and issues new bonds, their new bonds are maybe paying 6%. So nobody's going to give you $1,000 for your bond paying 5% if they can go buy a bond for $1,000 from the company paying 6%. Therefore, your value of your bond goes down. Now, when I say that, the question that I always get, but wait a minute, Derek, if my bond goes down on paper, if I still own the bond on the maturity date, assuming the company doesn't go bankrupt or become insolvent, I get my $1,000 back, right? And the answer to that's yes. Well, the opposite happens, like a seesaw. If the Federal Reserve cuts rates, as you can see in the third description here, bond prices go up. And so if the Fed cuts rates, bond prices go up. And yes, bond prices can go up north of par. Somebody may say, hey, I'm willing to buy your bond for $1,200. That pays 5% because new bonds coming out only pay 4%. If you re-engineer that math, it kind of all works out to give you the same type of coupon. So why are stocks selling off? As I mentioned earlier, the U.S. markets, the S&P 500 down 25%, international markets down 27%. Look at the sectors of the markets. Let's unpack why markets are selling off, okay? We're going to get into the economics of things and really talk about some stuff. So most of you have seen this, how are companies valued? I'm going to take the next 2 hours, I'm going to explain every variable to you inside of that equation. Just joking, I'm going to explain it with a ice cream store. Pretend for a moment, most of you have heard this, but pretend for a moment you and I own an ice cream store. We make $1 million a year. That's what we have coming in, okay? With that $1 million, we pay for our ice cream, we pay our employees, we pay our rent, we pay, all the stuff that we need to pay to run the business. We're left with $100,000, okay, of revenue. We've been doing it for 30 years. We've decided it's time to hang up the ice cream scoop. We're retired. We're going to hire people. We're going to sell the ice cream store. When we go to hire these people to help us sell the ice cream store, okay, we're typically going to end up getting someplace between 3 to 5 times earnings. In other words, somebody's going to pay us $300,000 to $500,000 for the right to ring that cash register for the next 30 years. So 3 to 5 times our earnings. Remember, we made $100,000. Okay. So very quickly, that's a privately held company. That ice cream store. We don't trade publicly. We're not stock that trades on the New York Stock Exchange or anything like that. It's privately held. That's what we get 3 to 5 times. However, if our ice cream store was publicly traded on the New York Stock Exchange or an exchange, okay, do you know what we would get for our business? On average, our 100,000 that we earn, we would get a 17 times multiple. Really about 6.85, but I'm just going to call it 17. We'll dig more into it here in a second. But we would get a check for $1.7 million. Why does a publicly traded company get a valuation of 17 times where a privately held only gets a 3 to a 5? That difference is 12. Well, that 12 is what's called the liquidity premium. When a company IPOs, it's a privately held company that's now becoming public, and it goes up in price. Why? Because pretend tonight you read in the newspaper, or tomorrow morning you read in the newspaper, ice cream causes cancer. Okay, you own publicly traded stock in an ice cream company. We'll call it, whatever, Haagen-Dazs or something. With the click of a button, you're no longer in the ice cream business. You've exited the ice cream business. You're no longer an owner in the ice cream business. You could sell it really quickly. Pretend the ice cream store is privately held. That article comes out in the newspaper. All of a sudden, that line that is outside of our store, right, to buy ice cream, it starts to dry up. It starts to dry up, and instead of us earning 100,000, pretend we now only earn 50,000. What's the value of our company at 3 to 5 times earnings? 150 to 300 versus what it used to be at 300 to 500, right? And so the liquidity premium is why publicly traded stocks get a higher multiple. Okay. And so I bring that up to explain why companies are selling off. Inflation, okay? So our inflation rate in the US, as far as our last reading, which was in August, came in at 8.2%. So inflation simply being, the price of things going up. So think of this. Let me put this into normal terms. It's the middle of the summertime. Pretend, you're working at your job. You're getting paid, let's just call it $100,000 a year, but you used to pay $50 a week to fill up at the pump, and now you're paying $300 a week or whatever to fill up at the pump. You say, hey, you know what? I'm not going to take the kids out for ice cream tonight. Okay, I'm not going to take the kids out for ice cream tonight because your dollar's being stretched in other areas. Those are those inflationary pressures. Earlier, I talked about consumer discretionary. Ice cream store spending would be consumer discretionary, right? Not going to take the kids out for ice cream. And so our inflation rate at 8.2 was our last reading. We will have our inflation number coming out here in the next 2 weeks. We'll get to that in a moment, okay? But if you think about it, here's inflation. These are the averages through the year. We saw inflation extremely low over the last decade. At the end of 2021, we started to see inflation pick up. Chairman Powell, the Federal Reserve, said, hey, it's transitory. In other words, it's going to cool on its own. And most of you, or some of you, have joined these webinars before. We said, listen, one of the reasons why you have high inflation is because of the supply chain issues that you had coming out. You had the government inject all this money. People, what's the definition of inflation? Tons of money chasing too little goods and services, and so the goods and services get pushed up in value. That was combined with the whole stuff through COVID and the supply chain issues. We'll talk a little bit about the supply chain. But so far in 2022, and this graph says 8.3, but that's kind of been the average read over the first 8 months of the year, that 8.3. Now listen, inflation's a global problem. We're seeing inflation around the world. You can see globally in August, the global inflation number, 7.6. When you see this DM, that stands for developed markets, such as the US and developed international. EM stands for emerging markets, as we discussed earlier. When you see developed, you can see US, Canada, Japan, Greece, so on and so forth. And look at those inflation rates. There's the US 8.3. In the emerging market areas, you can see their inflation rate. Look at Mexico, even Brazil, India, so on and so forth. And so global inflation, right? So eating away at people's purchasing power. So there was a survey done, and when they surveyed 1,038 US adults, this survey was done between June 29th and July 11th. They went out and they asked folks, where do you plan to cut back on your spending? And 66% of the people being interviewed said contracts and subscriptions, such as I'm going to get rid of my cable, or I'm going to get rid of the YouTube, or I'm going to get rid of Netflix, or those types of things. Clothing, eating out, travel and vacation. You can see the study right here on the left-hand side. It is no wonder why you see communications. I'm going to get rid of the cell phone, or I'm going to, get rid of I'm going to get rid of the kids line on the cell phone, or whatever the case may be. Technology spending. Apple just came out with a new phone, right? How many people are like, yeah, the phone I got right now is just fine. Like me, I got an iPhone 12 because I always wait. Consumer discretionary, right? Down 30%. How many people cut back, right? Also, sorry, I did want to point out one other thing on that slide. It is of no coincidence when you break it down by the further breakdown, internet, semiconductor, software, so on and so forth, why these particular sub-industry areas are down what they're down. Think about it for a moment, okay? Let's keep working here. So how's the consumer really doing? Right? Because at the end of the day, when you talk about the economy and what's going on in the stock market, when I said, why are stocks selling off? Well, back to what I was saying to our ice cream store. If companies aren't projected to make as much in earnings, their stock price should go down to reflect their 16.5 or 16.85 multiplier, right? And all the stock market's doing is the stock market is future projecting. What will these companies earn? But let's talk about how the consumer is really doing. Let's think about it. So listen, wages. Wages are up year over year. In our August reading, wages are up 6.1%. In other words, that person who made $100,000 in 2021, they are on average today making $106,000. Okay. As you can see here on the blue line, that was our year over year, August to August, right? Unemployment. So unemployment today is at an all-time low. Our August reading 3.7%, 3.7%. Average unemployment, okay, over a 50-year period of time, 6.2. We're at 3.7, well below the average. Average wage growth over a 50-year period of time, 4%. Remember, wage growth at 6.1. Wage growth and inflation, let's bring them together for a moment. So August to August, you have inflation of 8.3. You have average wage growth of 6.1, okay? Therefore, your average consumer's taking a cut in pay of 2.2%. That's it, 2.2. Now, by the way, for those of you who have been on historical webinars, so on and so forth, inflation 2 months ago was at its high point, 9.1. We came down, inflation last reading at 8.3. Market didn't like that. Expectations were inflation was going to be at 8.1. Joe Biden was on CNN, and I was looking at Twitter feeds and social media, and people were saying, oh, did you see Biden? He said inflation was only up a smidgen. What Biden was trying to say was, listen, the inflation number came in at 8.3, expectations were 8.1, it was only up 0.2. It's a lot to do about nothing, right? It wasn't like, we've been coming down. He was absolutely correct in what he said, as an FYI. So inflation has been coming down, but this is what the consumer's taking a pay cut. That's the whole hoopla about everything. Now, really, the market's forward looking. And so the market's worried about this gap widening. What we've been saying is we see the gap closing, and it has been closing, 9.1 down to 8.3. Okay, and that's in 2 months. And this number, this 2.2, what you hope is that wage growth is north of inflation. And if wage growth is north of inflation, what happens to expectations about companies' earnings? Hey, I'm going to take the kids out for another helping of ice. I'm going to take them out once a week. I'm taking them out twice a week because I got more disposable income. And this is what a lot of the hoopla is about. The labor market if you go into a house that costs $100,000 or $100 million, and you go into the basement, and of course the $100 million house probably got a very well redone basement, but you take that all out. It's the same concrete. And so when I think about the economy and I think about the concrete inside of the economy, it's the labor market. It's what holds up the building. And the labor market is extremely strong. In fact, the strongest that it's ever been, with exception of a little bit back in the 50s, but a lot of that 50s labor demand was because of the war effort. The strongest labor market we've ever seen. In fact, for our August reading, for every there's 2 job openings for every unemployed person. So if somebody wants a job, there's a job opening for them. Now think about that. There's a job opening for every unemployed. There's 2 job openings for every unemployed person. Okay. So there's all these job openings. And when I say, 2 for 1, the number really comes in at 1.87, as you can see here. That's what this is showing you. It's showing you, okay, the labor demand, the ratio of job openings to job seekers. Now, what that is doing is that's leading to wage increases. So think about it. You and I own a company. We need a new IT person. We put an ad out there to hire a new IT person. We put an ad out there at 60 grand. Nobody applies. 80 grand. Few resumes. 100 grand. 120. The more we go up in salary, the more resumes that we get. And because people are fighting to hire employees, they're doing things like offering people signing bonuses and stock options and all these different things. Interestingly enough, if you look at the upper right-hand corner of my chart here, you see JOLTS. And what this means is this is job quits. So if you notice, our last reading back in July, the amount of people quitting their jobs is at an all-time high. Huh? What? How's unemployment so low? People are quitting their jobs. Hold on, I'll explain in a moment. And then down below in the bottom right-hand corner of my chart, you see layoffs. Layoffs are the lowest that they've been in 22 years, right? See the blue line, the lowest they've been in 22 years. So people are quitting their jobs not because they're leaving the workforce. They're quitting their jobs because they say, hey, I used to be an engineer at Google making X. They just offered me a job over at a competitor of Google making Y, and they took a big increase of income, and that's, you see wage growth going up plus competition for workers. Okay, so at the strength of the labor market, you see this stuff. Now, is that inflationary? That's inflationary somewhat in itself, but not necessarily bad inflation. As you noticed, right, it helps offset the price at the pump and the price of food, so on and so forth. But there's more to this, and so let's keep working here, right? But the consumer, from a labor standpoint, there's opening of jobs, and that looks really good. Inflation's kind of a negative thing that sits behind it. If you look at consumer finances, so the consumer's balance sheet, okay, the first thing in the upper right-hand corner, you see household debt service ratio. In other words, out of the money that Americans bring in, what percentage of it disappears to pay down liabilities, such as mortgages, student debt, other revolving credit, so on and so forth? Right now, third quarter 2022, it's about 9.5. So in other words, about 10 cents of every dollar disappears to pay down liabilities, right? This graph goes back to 1980. You can see back in 1980, it was 10.6. Before we entered the global financial crisis, it was 13%. We had interest rates come way, 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 way down. right? The lowest they were ever in the history of the United States, just 13 short months ago, where you had, this number even closer to 8.5, so less money disappearing. Therefore, more money inside of the consumer's wallet to do what? Consume, to buy things, to buy whatever they're buying. Every company on the stock market sells something essentially, right? Um, and the other part about it is, although, if you remember when I showed you that graph and it said time was on your side, and I said, hey, if you went out to Antarctica, and I said, hey, listen, your portfolio almost hit 400 grand, 11 months ago, now it's down to 300 grand, but you only invested 100,000. What's the balance sheet of the consumer look like? So at the end of Q2, the U.S. balance sheet represented 162 trillion. So that, if you think about this on a graph, 162 trillion. By the way, the peak prior to that was right before the global financial crisis, where consumers' balance sheets made up of homes, tangibles, deposits. When it says pension fund, that includes IRAs and 401ks and so on and so forth. Other financial assets are, regular investment accounts. But in 2007, before the global financial crisis, 85 trillion. So in other words, balance sheets have basically doubled. The consumer's wealthier than they ever have been in the history of the US, with the exception of 13 months ago. Okay. In other words, the consumer on a balance sheet standpoint looks pretty darn good. There's total liabilities totaling, just shy of 20 trillion, but assets 162 trillion. Okay. Will the consumer continue to spend? One thing about that consumer confidence number, I pointed out, when it's very low, markets tend to do well, that type of thing. But when people don't feel good, they tend not to spend. I'm not going to take the kids out for ice cream tonight. Think about what that does to earnings and everything else. Let me give you an example. It's 2008. Pretend you work in a job as a educator, a teacher, okay? You're not getting laid off, right? There's still kids that you got to educate. It's not like you're out selling widgets and the company goes, hey, we're not selling any widgets, we're going to lay you off, right? They don't, you're a teacher, teach third grade, you're not getting laid off. You know what your salary is, okay? And it's 2008. And you live in a neighborhood, and in that neighborhood, there are people getting laid off, okay? And you're at the barbecue on Saturday, neighborhood barbecue. And, oh, hey, John down the street, he got laid off. They lost the house. Hey, Susie up the street, she got laid off. They lost the house. Remember, you're in education. I use education because, like, you're not going to get terminated, right? Like, it's not, I guess you get terminated, but you catch my drift. Well, in your mind, you might be like, oh, geez, I better tighten the belt. I'm not going to go out and get the new iPhone. I'm not going to take the kids up for ice cream. Think about it. Your situation, your salary's the same, right? Now, listen, inflationary pressures may play into it, but my point is here on consumer sentiment is there's some psychological elements inside of there, right? And if you stop spending, okay, for whatever reason, on these things, consumer discretionary, technology, communications, all way down for the year. Think about it. Makes kind of sense, right? So the question that I have, even though I explained that as like a fixed income type of person, will inflation cool? Now, I gave you a little bit of the answer yesterday saying, hey, 2 months ago, we're at 9.1, now we're at 8.3. But let's unpack that even further. So inflation components, energy, vehicles, shelter, vacation, right? Vacation, travel, so on and so forth, and food at home. So let's unpack and see what's going on with that stuff today. Let's start with energy, okay? So what you're looking at here, basically, I want to draw your attention to the chart on the right. It says price of oil. I'm going to ignore the data on the left for now because it doesn't matter. What you're looking at here is this is a graph of the price of oil from 2002 until current date, September 30th, 2022. You notice back in 2002, look where oil prices were. Oil prices were about $28 a barrel. Obviously, from 2002 all the way until July 3rd of 2008, you see what happened with oil. Oil went up to $145 per barrel. I could keep going along this line, but here's where we are today. Oil closed, WTI closed trading on September 30th at 79.49, $79.49 a barrel of WTI. Now look, not too many moons ago, if you notice right here, we had oil above 120. So January 3rd was the first day of trading of markets for this year, 2022. Oil closed at $76 a barrel, January 3rd, 2022. 3 short months later, at the end of March, WTI closed at $100 per barrel. That represented a 32% increase in oil in 3 months. Okay, annualize that, it comes out to 120% for the year. September 30th, so just, Friday, WTI again closed at 79.49. So for the year, oil is only up 4.48. Now, when I say that to you, like, wait, what do you mean? Well, remember, in those inflation numbers, we got up to 9.1, we're at 8.3, is energy. Energy represents a pretty big component of inflation, okay? So I asked the question, and I'll continue to ask the question, will inflation cool? Now remember, I'm now focusing on that right-hand side of the chart. September 30th, oil closed at that 79.49, only up 4.48 for the year. Earlier, I showed you markets were on fire today, right? Up 765 points on the Dow. Basically, all markets were up 2.6%. But I bring that up because one of the best performing areas of the markets today was energy. I also want to show you this. Even though I show you these numbers and I say, hey, listen, here's where oil started at the beginning of the year, here's where it closed just yesterday, only up 4.48 for the year. Remember here on the chart where I said oil was above 120? So look at in March, earlier I said, hey, March 31st, oil closed at $100 a barrel, it was only up 30 some odd percent for the year. But realize, look, on March 8th, oil was at 123. Remember, Russia-Ukraine invasion, oil spiked way up. Look at in May. In May, right, pretty hot prices of oil. Look at June. June was a horrible month for the markets. Look, oil almost got back up to 123. It's March high in June. And so on March 8th, right, think about it, 2 months into the year essentially, oil was up 62% for the year. Think of that annualized, right? It's crazy. By the way, oil back up today. Oil closed today, October 3rd, at 83.35. And at 83.35, it added a little bit more, growth for the year, but we'll see where oil goes. I've said this to you all. We're fine with oil kind of hanging out between 80 and 85, right? 80 and 95. Okay, it's not going to be inflationary because the average price of oil for the year at this point hovers someplace around that $86 to $87 per barrel. So we're fine with it kind of hanging around there. It won't add to the inflationary numbers. But I asked the question, will inflation cool? And I'll continue to ask that. What I want to say to everybody is we keep our eyes keenly on the energy market because you can follow the price of energy. And if energy shoots up to 130, I said at the beginning of tonight's webinar, I'm going to make some forward-looking projections. One of those projections is we'll continue to see inflation cool. One of those components of inflation is energy. Now look we're going to get into the winter months. And listen, in the winter months, the argument of the whole Russia-Ukraine thing, what's going to happen in Europe? Even here, oil prices, energy prices tend to go up in the winter months. However, there's a flip side to that coin, and the flip side to that coin has to do with a political statement or a political type of discussion of opening up more drilling leases and so on and so forth. And even though people say to me all the time, Derek, if they open up more drilling leases, that doesn't add a drop of oil to the supply until 12 years from now. Well, that's absolutely correct. However, oil trades on a futures market. Markets trade looking into the future. And therefore, what it's saying is, hey, there will be more supply from oil down the road. Therefore, prices fall down. We watch this. And, if oil hovers between this 80 to 95 bucks, it's stabilizes. If we go lower, hey, even better, it brings inflation down. So will inflation cool? Prices at the pump. National average today on 10-3 was $3.79. By the way, a year ago, is that going to highlight for me? As you can see down the bottom, a year ago, your average price at the pump for regular gasoline was $3.20. Average price today was $3.80. So over the last 12 months, that's about an 18% increase. Oh, Derek, wait, 18%? Didn't you just say WTI at the close of business on September 30th? Oil's only up like 5%? Yeah. Okay, why at the pump is it up 18? Well, I'm talking about a barrel per oil. Okay. Think about it. When you go to fill up your tank, what do you got to do with that barrel of oil? You got to refine it. You got to transfer it. You got to pay a person working at the gas station. You got electricity. You got bill. Blah 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 blah. And so there's that. And then also, it generally takes time for that price to come down at the pump. Now, you have noticed that price slowly coming down at the pump over the last 3 to 6 months, right? And that's helping cool inflation. Next, quite interesting, commodities. So look at this. This is where the commodity indexes are for the year. At the close of business on September 30th, you have gold down 10%, silver down 20%, copper down 24%, steel down 14%, and aluminum down 24%. Now, a lot of times when I show that to people, they're like, what? I heard building supplies were way, 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 way up. And I would say to you, well, they were. And I'll make point to that in a moment. Look at wheat, live cattle, corn, cotton, sugar, and soybeans. Okay, you can see that wheat, live cattle, and corn all up. Okay, look at cotton, sugar for the year down. Look at soybeans down. We're going to keep working on this. It's no wonder home builders, gold miners, agriculture stocks conglomerately, okay, metals and mining, those sectors all down for the year. But look at this. Will inflation cool? Now let me show you this chart and make my point. So this is a chart of commodity prices going back to 2021 until when? September 30th of 2022. So let your eye just focus right here at the end. You had commodity prices kind of mid 2000, beginning of 2020, that type of thing start to go up, as you can see here with this line. We got into the middle of June. So when I say June, right, it's kind of chilly out. It's October 1st now, but it seems like it was just June yesterday and it was 100 degrees outside, right? It was only a few months ago. Those commodity prices, hey, Derek, I heard building stuff's way, way, way up. I got a contractor, he's telling me you can't even buy sheetrock. It's cost them $200 a piece of sheetrock, so on and so forth. All of that was true the first 6 months of the year, okay? Look at my chart here. You see this year-to-date change? Okay, but look at what's happened since June 9th. Okay, by the way, my birthday is June 9th. So, on these stuff started to roll over. It's good news from an inflationary standpoint. Energy down 26%, okay, across the board. Look at agriculture. So corn, soybeans, wheat, so on and so forth. Look at that stuff since June, all coming down. So even though on the last slide, right here, I show you wheat, live cattle, corn, soybeans all up, still up for the year as of September 30th, but from June until September 30th, okay, June 9th, all rolling over. Copper, aluminum, zinc, gold, look at all that stuff, just way, way down. So again, I asked the question, this is kind of the graph, right? Up the first 6 months of the year and hugely down over the last 3 months. Okay, will inflation cool? Talk about housing. This stuff's crazy. Listen to this, okay? December 30th, 2021, at the very start of this year, if you went and took a 30-year mortgage, on average, nationally, that your rate came back at 3.11 nationally. The last reading, September 29th. If you went and took a 30-year mortgage, September 29th, 6.7%, more than 100% increase in a 30-year mortgage rate, okay? In a 30-year mortgage rate, that's national average. Now think about that. Say it's your first home, you were out there shopping. It's only been 9 months. So, it's like January, you're getting done with the holidays, beginning of the year, February, still kind of cold out, March, April. All right, we'll go look at some houses. Went through the summertime. Finally, you kind of found maybe something you like. And all of a sudden, your payment went from 2 grand, you're like, I spent 2 grand or whatever. I'm just making up numbers, but 2 grand a month mortgage. And all of a sudden, same house, right? Same cost, if you will, 4 grand a month, right? 100%, more than 100% increase in the interest rate. Will that cause inflation to cool? Will that cause home prices to come down, so on and so forth? Will inflation cool? This is a forecast of where home prices will go. And so just to kind of put some context around it, Q1 of 2020, so that was right at the beginning of the COVID pandemic, the median home price in the entire nation, although these home prices, especially for those of you in and around the Denver metropolitan area, may sound insane, but the median home price, 272 grand, okay? Fast forward, got through COVID, went into 2022, beginning of this year, median home price 361,000. Government injecting money, interest rates came way, way down, 32% increase. Forward-looking projections. Remember, Q1 2022, national home price 361. It's the same number from above. Q1 2023, national home price is expected to be only 376,000. It's only a 4% increase. In fact, I was kind of curious about that because maybe you would think home prices would come down a little bit. And if you look at the graph here, you actually do see them coming down. And then you see in 2023, home prices percolating back up. Why? I'll unpack that in a second. We're almost done. But will inflation cool? If you look at home prices and affordability, the data is July to July, so it's July 2020, July 2021 to the end of July 2022. Miami up 32%. National home prices around the United States up 15.8. There's Denver, 15.6, and you can see the other cities inside of there. Look at the Housing Affordability Index. The Housing Affordability Index is an index that basically takes the information, whatever Americans are earning, where a population centralized, because obviously probably housing in South Dakota is more affordable, than New York City, that type of thing. So they take in that type of information, population density, income in that population density, as well as a handful of other information, and they come up with the Housing Affordability Index. And you notice the July 2022 number, less affordable in housing. Why? House prices are going up, mortgage rates are going up, okay? Yes, you have wage increases, but you notice the chart, right? Less affordable. And kind of interesting, I threw this graph in here, credit score. So if you think about it, how are banks approving people? So think about prior to 08, right? You went into the bank, the second you walked in, the guy put a mirror underneath your nose. If it fogged just a little bit, hey, we'll give you $1 million loan, right? And that led to the global financial crisis, right? That type of lending practices. Well, after the global financial crisis, pendulum swung greatly. And they said, hey, in order to get a loan, we need your blood type. We want your DNA profile. We want 900 years of tax returns and everything else. And we only approve people that have very top, 780 plus. Obviously that pendulum tends to swing. So, only fog the mirror, and now we want your DNA. And you notice the graph kind of coming down after the 08, 09, and then as of late, especially with home prices going up and people paying more than what the home comes in at value, you notice scores went up again. And then banks now are lending to, it's not like it was back here, okay, but you notice that banks start to drop their lending standards because they want the velocity of loans, right? Because think about all those ingredients mixed in. So the Federal Reserve, this is kind of crazy. The data that I'm showing you is directly from the Federal Reserve. And so what you're looking at here is the federal funds rate. What in the world is the federal funds rate? So all the federal funds rate is, the Federal Reserve is the central bank. Think of them as controlling all the money. And all the other banks are what are called member banks. And so Wells Fargo is a member bank. They go to the central bank called the Federal Reserve, and they say to the Federal Reserve, we want to borrow money, and only member banks can borrow money from the Federal Reserve. You can't take a loan from the Federal Reserve. So the Federal Bank, Federal Reserve, central bank, says to Wells Fargo, okay, you can borrow money at this rate, and that's the federal funds rate, okay? Wells Fargo turns around and loans you the money at something higher than they borrow the money at. And that's how Wells Fargo earns money. This is crazy. Listen to this. January 2020, no COVID, right? COVID was like, it's in China. I don't know if it's what's going to happen with COVID. Federal funds rate 1.75, okay? March 2020, the Fed in March cut interest rates by 50 basis points. They cut the federal funds rate by 50 basis points. They brought it down to 1.25. If you remember, March was really the beginning of the pandemic, okay? It was here in the United States. Later in March, right, as April was beginning, the Fed made an emergency 1% cut. They brought the federal funds rate down to 0.25, the lowest it's ever been in the history of the United States of America. It's never been lower. Remember earlier when I showed you that graph of consumer finances and what percentage of the dollar disappears to pay fixed debt? Think about how many people refinance. I was on the phone with a client of mine a week ago, and they're thinking about moving, and I pulled up their mortgage statement, and they got a loan at 2.6%. I said, guys, if you go buy a new house, the new house, you're going to be at, 6.75. I mean, and they just happen to, buy when rates were super duper low and everybody refinanced and everything else. And by the way, that 0.25 federal funds rate remained from March of 2020 until March of 2022. 2 very long years, okay? The Fed made their first interest rate hike on March 16th of 2022, as I alluded to earlier when I was showing you the monthly breakdown of what's gone on in the market, and they raised rates 25 basis points. They brought the federal funds rate to 0.50, still remarkably low, okay? From there, May 4th, the Fed rose another 50 basis points up to 1%, okay? And you kind of know the story from there. June they raised, okay, and they raised 75 basis points. July they raised, and in July they raised 75 basis points, bringing the federal funds rate to 2.5. And then in September, so just 2 weeks ago here, they rose again 75 basis points to 3.25. Now, why is this important? Okay. The reason why it's important is it goes back to those earnings, okay? When you raise the federal funds rate, think of that federal funds. Why did they cut rates for COVID? Why are they raising rates today? So think of the economy as a cup of coffee. You don't want the cup of coffee too hot. You don't want it too cold. So what do? You make this cup of coffee. It's really hot, piping hot. You pour cream into it to cool it down. When the Federal Reserve raises interest rates, they're effectively pouring cream into the coffee. They're cooling it down. What's the Fed trying to do? The Fed's trying to bring inflation down, okay? And they're actually also trying to make unemployment higher. So the Federal Reserve wants inflation, core inflation, to be at 2%. So I just said something, I might have lost you. Core inflation. Earlier, I told you inflation's at 8.3. That 8.3 number includes 2 things, food and energy, okay? There's another reading that strips out food and energy, and it's called core inflation. Core inflation right now is only at 6.2, okay? So it's right in line with wage growth. But let's face it, not the average American, every American is paying for food and energy. So the headline inflation number at 8.3 is what's important, but the Fed wants core inflation at 2. People say, Derek, how are we going to go from 8.3 to 2? I say, listen, I understand it's a big delta, but it's not 2 to 8.3. It's only 2 to 6.2 because the Fed's talking about core inflation. They have a mandate, inflation at 2, okay? Number 2, unemployment at 4%. Unemployment today is at 3.6. Why does the Fed want unemployment at 4? Why not have unemployment at 0? Because of the inflationary nature. they find that the proper mix of ingredients is to have unemployment around 4. Remember earlier I said to you, hey, for every unemployed person, there's 1.87 jobs that are open for them. Well, and again, I asked the question, will inflation cool? 2 months ago, that was at 2 job openings, 2 job openings. So we haven't gotten reports of massive layoffs, but we've definitely got reports of companies saying, we're going to freeze hiring. We're going to freeze hiring, right? We're not going to hire anybody new, okay? So on September 21st, very interesting. Listen to the entire Federal Reserve speech and everything else. They raised 75 basis points. They brought the federal funds rate from 2.5 to 3.25. By the way, very expected by the stock market. Why did the stock market on September 21st sell off nearly 1,000 points? It's not that simple. I'll explain in a second. But before I do, why is this federal funds rate important? Well, think about it. Say you have a variable loan, like a HELOC. Say you have a variable revolving credit, like a credit card debt. Say you rent corporate leases, okay, like our rent here, okay? Depending upon what the inflation rate is, every year when your lease comes up on its annual, you might sign a 5-year, but every year, hey, what's your rent increase going to be? It has to do with the federal funds rate. And so when those things go up, more money leaves the consumer's pocket to pay that fixed debt, and therefore they have less money to go and spend on those consumer discretionary things, those technology things, all those things that I just mentioned. Energy and utilities, you kind of have no choice about, so they've been kind of a safer haven, right? Catch my drift. That's why this is important. It cools things down. Okay, so this was not unexpected. The Fed basically signaled that they were going to raise 75 basis points in September. And when I said I listened to the whole meeting, this is how nuts it was. September 21st, stock market opened up, futures market was down 200. Before the market opened up, you knew the market was going to open up down 200. It was the day the Federal Reserve was coming out. Federal Reserve made their announcement at noon. From stock market opening up 7:30 a.m. Mountain Standard Time until noon, market kind of hung out down 200 points. Federal Reserve came out. It's kind of crazy how they do it. It reminds me of a concert. Powell comes out, Chairman Powell comes out, and he says, hey, we're raising rates by 75 basis points. And then he goes in the back, and the podium's just sitting there, and there's a whole bunch of reporters. He's in the back for like 45 minutes. You know, like the crowd's got to cheer. He's got to come back out. Comes back out 45 minutes later, he does the press conference. He answers all the questions. And it was the second question that was asked. And the second question that was asked was, Chairman Powell, you've taken rates from 0.25 at the beginning of the year up to 3.25. By the way, from a percentage standpoint, it's like 1,200%. Huge amount of rate increases over the course of 9 months, okay? Volcker, people go, oh, you know, Volcker did the same thing. Volcker took the federal funds rate from 10 to 20, 100%. Powell's taken the federal funds rate from 0.25 to 3.25 in 9 months. It's a 1,200% increase. But anyhow, the reporter asked Chairman Powell, listen, this is what you've done. When you do this, okay, it takes time for it to cool inflation, right? Like, you know, think of it, you got these ingredients, you got to stir the soup up. It's not like you raise today and inflation goes down to 2 tomorrow, right? Think about it like this, like, you know, you say somebody who bought a house 3 months ago, right? And they locked in at a rate of say 4.5%. Well, you know when they report the numbers for the new houses that were purchased, okay, they're not included in that number. They're included 2 months later. On average, it's 50 days to close, but they locked in a rate at 4.25 on their 30-year mortgage. 2 months later, they close. They're in that number. Somebody looking today might not buy today because rates are at 6.75. In other words, when you raise rates, it takes time to stir it into the soup. Chairman Powell said, you're absolutely right. At some point, the Federal Reserve needs to slow down its accelerated rate hiking to taste the soup, to see what's happening. Market went from 200 points down to up 300 plus points. It made an almost 600-point turnaround in the course of a minute, just by the chairman saying, Yeah, you're right. At some point, we have to take a step back and taste the soup and maybe slow down our aggressive raising, or at least take a step back and see how it's working. Market shot way up. Okay. The next questions, he gave a very hawkish tone. We're going to beat inflation down. We're going to have inflation coming down. And of course, the market had a huge sell off. And so, listen, the economic calendar. In October, we got a number, October 6th, we have initial jobless claims coming in. We'd actually like to see them go up a little bit. I don't think they will. The consensus is, if you notice, right, 203. I think, we might in October, but typically as we get into the fourth quarter, we have a bunch of seasonality work. You think about it at the mall, you got people that take, a job a few hours here and there because retailers need more help. You got people gift wrapping and that type of thing. And then really, the granddaddy of the information is October 13th. And October 13th, we got the CPI number. And we'll see where CPI comes in, right? 8.3, we'll see where it goes. We'd like to see it come down. Now, interestingly, the Fed does not have a meeting in October. They skip October for Halloween, I guess. So the next Federal Reserve interest rate decision comes out right at the beginning of November because they skip October. So on November 2nd, the Fed is expected to raise 0.5 to 0.75. Okay, 0.5 to 0.75, which would bring the federal funds rate to 4.25 or to 4.5%. A large portion of that's going to be dictated on this jobless claims number and on CPI data that comes in through the month of October. If we see it cool, okay, and the Fed doesn't raise 50 to 75, maybe they only do a 25 basis point raise, markets are going to rally. In fact, today, why was the market up so much today? I don't know if you people saw it, but the UN came out and the UN said to the Federal Reserve of the United States of America, stop being so aggressive raising interest rates. The market went up 700 points. December 14th, we will get the Fed meeting. And on the 14th, that'll come out around 1 p.m. Mountain Standard Time. And that, again, we'll see where that meeting goes. And it'll largely depend upon the economic data. By the way, very quickly, if you think about it, you go, hey, geez, Wells Fargo gets to borrow money from the Fed at 3.25. They loan it on a 30-year at 6.75. Seems like a pretty good spread. And if you go and you go, hey, what's the federal funds rate? Typically what you find is what's called the effective federal funds rate. What in the world's the difference between the two? So right now, the federal funds rate's 3.25, 3.25, right? But remember, you're a member bank, you're Wells Fargo. You were borrowing money 2 months ago, 6 months ago, 12 months ago, so on and so forth. So when you look at all the money that was borrowed by member banks, the question is, what's their cost for that money? Their cost for that money, okay, at the end of September, because of those different rates that they get to borrow from the Fed, only 2.3. Only 2.3 on that money, turning around and lending it at 6.75. And that's on a 30-year mortgage. What if they're lending it on a piece of development land or on a start of a new business, higher rate, or on a HELOC, higher rate, okay? Now, I said something earlier, and I want to go back to this slide. And the reason why I want to go back to the slide, and I found my drawing tool right at the right time. This graph that you see here, this is the Federal Reserve's own graph. See this purple FOMC long run projections, okay? And FOMC year-end estimates. This is the Federal Reserve saying to you, here's where we are today, so 3.25, okay? Here's where we see things going. See this year-end estimates? This is 2024, 2023, this is 2025, and this is over the long run, they call it, 2.5. So the reason why I'm pointing that out to you is, do you remember earlier when I was talking about bonds and I was saying, hey, what if the Federal Reserve cuts rates? The Federal Reserve is actually saying to you, hey, we expect to take rates down towards the end of 2023 into 2024 and continue to cut rates down after that. Do you remember earlier when I showed you that graph of the housing market and I said, hey, housing dips for a little bit, but then shoots back up at the end of 2023? Well, the reason for that is the housing market is also looking at that going, hey, we think that, listen, with the interest rates going up, obviously it'll slow sales, prices will come down. Then from the Fed's own projection, they cut rates, housing goes back up. Same things with bonds. That's why I gave you the 3-year. Okay. That's why I said, hey, what if rates get cut? Bond prices go back to par prior to the 7.4. And again, long run. Now, again, these are forward projections, right? If inflation's still high, the Fed's going to continue to raise rates. But this is from the Fed's website. Okay. So that's what they expect. Um, and I'm trying to get back to my thing here. We're almost done. Let's keep working here. Give me a second just to get back to this. All right. So, and I'll make my point here. The Federal Reserve is saying to us, this is also from their website, so this is from the IMF, Federal Reserve. Listen, 2022, we expect the average inflation rate to be at 7.68. That's headline. With everything that they're doing today, bang, they get down to around their 2% level as we get into 2023. Okay. And I asked the question, will inflation cool? Real quick, the supply chain, because the supply chain adds to these inflationary pressures, right? So what's going on with the supply chain? This is great news. I said this to you in March. I said this to you in June. The supply chain gets better every day, every week, every month, and every quarter. Yeah, there'll be hiccups along the way. June was an awful month for the stock market. One of the reasons June was such an awful month for the stock market is because China shut down north of 14 cities. When I say shut down, not an American shutdown, I'm talking locked in your house shutdown, no manufacturing. Remember, China produces a lot of stuff around the world. But look at this, global supply chains and inflation. So if you notice, here's August, and you notice faster delivery times. So we see, right, we had, this goes back to 2005, right? This is normal inside of here. Look at this, very interesting. Purple dot. We'll have September's numbers come out in the middle of October, but we're getting back to normalcy on price manufacturing supply times, how long it takes to get in whatever you're ordering, right? Manufacturing. If we look at input prices and output prices, no different than I showed you earlier, commodities rolling over since June 9th. Okay, my birthday again, it was a good omen, right? Because commodity prices started to roll over. But you notice, see prices rising, prices falling, input prices. Look at that. That was August, but coming down, coming down. We want to get back into the 50 to 55 range, but we're headed there, and you notice V-shaped downwards. We get back to normalcy. Building material supply chain, August 2021, red getting worse, yellow the same, getting better. Look at that red, August, September. So that was your contractor. Hey, sheetrock, I can't even find the 2x4s. They're out of them at Home Depot. August 2022. So as I said, now listen, when I made that forward-looking statement a year ago, I didn't know that the graph was going to look like this. And I was showing it to you every quarter going, hey, listen, it's kind of getting worse, but, listen, the supply chain will work its way out. That's what I was saying. Supply chains work their way out. Supply chains work themselves out. Alleviates inflation. Another reason why inflation's coming down. Okay. PMI, global activity. I showed this to you at the end of June. Globally, PMI, you want PMI for global expansion to be above 50. What happens is that PMI goes out there, they interview 19 different industries, and they ask them questions very similar to like the consumer confidence, but they talk to price manufacturing, ordering folks that work at different companies, blah, 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 blah. Hey, how much you're ordering, et cetera, et cetera, et cetera. Above 50 shows expansion, below 50 shows contraction. So you maybe read it in the newspaper, hey, Apple adjusted their guidance. What in the world does that mean? What does it mean Apple adjusted their guidance? Back to that PE ratio thing, okay? Apple adjusted their guidance going, hey, we might not earn as much money over the next 12 months or the next 3 months or the next 6 months. Why would Apple come out and say that? Because they give guidance. Companies give guidance on their earnings. Why did Apple say that? Well, because no different than why I got an iPhone 12. Okay, people go, hey, prices are up. Maybe I'll wait till the iPhone 15 comes up. My phone's fine today, right? Okay. If I hit this, a new graph's going to come up because this was June. Here's August number globally, still fine, right? It's not in the red. You notice it's like kind of a nice orange, right? Okay, 49.3 globally. Here in the United States of America, 44.6. And you go, oh my God, does that mean we're going into recession? No, American companies are typically very quick at noticing supply demand shrinking. Now, I bring this up not to say that we're going into recession. I bring this up to talk about inflation cooling, right? Because people are tightening the belt a little bit. But look at this is August. This is where expected to be in September because prices at the pump and you see inflation coming down. You see it going back up. The inflation number is just a forecast. That's the actual August number. But remember, this was just June. And so this is just a few months ago. Look at the US in June, 52. And again, I flipped that page and you see it 44 in August, but trending back up. This is probably good news. Okay. So earlier I mentioned to you, privately held company, publicly traded company, 3 to 5 times privately held, publicly traded on average, 16.85 is what I said. That's the 25-year average. See that line right there? Hopefully you can see my mouse. So where are PE ratios on stocks today? Because why is the market selling off? Inflation's at 9, wage growth is at 6, average Americans taking a 3.3. Again, I showed you the math earlier, it's only 2.2. They're not going to spend as much. Earnings therefore come down, and when earnings come down, a company's stock price has to come down. That's the main reason why stocks are selling off. Hey, you got an aggressive Fed. When the Fed's raising rates, more money goes to pay for that debt servicing, if you catch my drift, therefore not as much spending, company earnings go down, okay? Companies today, PE ratio of 15.15. What in the world does that mean? If you notice on this graph here, it says overvalued. You had, going into 1999, at the beginning of the presentation, I said, hey, remember you had this new economy and 3 years of a down market. So back in 1998, 1999, you had PE ratio hit its all-time high, which is back here, about 123. It was absurd. Today, this little graph here, this is as of August. I just added this like 5 minutes before the presentation, so I didn't have time to update my spreadsheet. So I'm going to use this little graph, and you see my dots. Point being is the forward P ratio of the S&P 500 at 15.15 as of September 30th, 2022, puts us in this blue area. See the 14 to 16, so it puts us in this blue area. Stocks become attractive. You generally don't get into this very attractive area until you have very huge recessionary pressures. I mean, look at that. Look at where that we touched that green area, in the past. That was 08, 09. Okay. The cycle of a market motions. Again, most of you have seen this, but for those of you who haven't, check this out with me. When markets are going up, a bull market, my phone rings. Hey, Derek, I got an extra 100 grand sitting in my bank account, not earning any money on it. Don't you think I should invest it? And what this graph is showing you is that's what happens in a bull market, right? This is typically the time of most risk because things adjust. When the market's going down, what we're in today, a bear market. Oh, Derek, I should just sell out of everything. I can't stand to look at my statement. Point being, this is just emotional. This is not where you should be selling. This is the point of financial opportunity. My phone should be ringing that people found their extra 100 grand when markets are down like they are today, 25% year to date. These things don't tend to last long. Bond market down 15, crazy. Last slide, our speedometers. So we've showed you our speedometers over the years, monthly, quarterly, so on and so forth. Our speedometers looking out 6 to 9 months. Let's talk about them real quick. Monetary policy, you see it in red. By the way, when you see this gauge, the black gauge is where we put it today. The gray gauge is where we were last month. So listen, the Fed raising rates by 1,200% in 9 months. Have they done too much? Have they poured too much salt into the soup and haven't stepped back and tasted it? We're a little worried about monetary policy, right? There's three things historically that have caused a massive recession. Global commodity prices spiking. We had that kind of occur, but a sharp decline, as I showed you through tonight's presentation. I'm not worried about commodity prices right now, although we look at them every day. By the way, matriculating up a little bit over the last week or two, but hugely down since June. Okay. The other thing that's caused global recession, huge recessions, overvaluations. You hear people talk about a bubble bursting. So 1999, P ratios 123. Remember, average P ratio is 16.85, right? 123. Bubble burst. Okay, so we've had extreme valuations happen in the past. That happened in the 50s, it happened in the 70s, happened in the 80s, and then at the end of the 90s. But valuations today are not high; they're low, right? Just showed it, 15.51. The third thing that's caused massive inflation in the United States, going back to 1936, is an overly aggressive Fed. Monetary policies in red. U.S. economic outlook, you can see, we kind of lowered this down, at least for the next 6 to 9 months, but I still think the backdrop of the economy is pretty darn strong. The yield curve I won't get into. Consumer sentiment, the same. Consumer sentiment's gone up a little bit, as I showed you in the report. So again, that's why it's the same, but people still, might not take the trip, or I'm not going to take the kids out for ice cream. Disposable personal income, people are getting raises. That's all the same, right? Inflation's eating away at that, but that's why it's in yellow. Housing and mortgages. We view the housing market, again, as I showed you in the report, somewhat dipping, but then spiking back up. Why? Because that's a big shock. Beginning of the year, 3%. Today, 3.75. Crazy. Labor market and consumer spending. By the way, probably the two most important speedometers on this list. Labor market is strong. Remember, the size of the United States economy and labor market is enormous. It's not a speedboat. You can't turn it on a dime. Okay, and I'll make my point here in a moment. Okay, so the labor market, even if things were to cool too much because of monetary policy, it's not like this can go to red overnight. Consumer spending. Yeah, consumers are complaining about inflation, meaning prices at the grocery store and prices at the pump. But as I showed you earlier, people have gotten raises. People are wealthier than they ever have before. Think back when I showed you time is on your side. And I said, hey, look at the beginning of the year, you invested 100 grand 10 years ago, it's at 400, but now it's at 300. Keep in mind, if you invested 100, your annualized return was still 11. In other words, balance sheets are big. So, people are out there spending. Interest rates, as we talked about, fiscal policy, which is, basically monetary policy, so on and so forth. Business outlook and spending gone down a little bit. Back to that PMI graph I showed you. Remember, I did show you it go from 55 down to 48, now increase, or down to 46, but increasing to 49. So pretty neutral inside of there. Lending indexes, right? With interest rates going up, it's a shock to the system. People are like, I don't want to take a loan at 6.75. Corporate profits, Apple came out and said, hey, we might not sell as much. There's another reason for that in a second. Let's see if there's another speedometer I want to talk about. International economic outlook. It's when the U.S. coughs, the rest of the world catches a cold. So what I'm saying is we're not too late to create a recession, big recession here in the States. I'm going to give you a forward projection at the end of this in a second. Political environment's never green. It's always bad. Inflation, but we see inflation improving, right? Inflation's not going to turn over time. We're too big of an economy. It doesn't turn over time. It's slowly coming down. We're already seeing it happen, okay? Credit demand and availability. Credit's available. Demand's drying up a little bit for credit. Energy costs, see that in neutral, nothing's changed. Equity market valuations, 15.5 is attractive. Okay, geopolitical risk is always in red. We're going to get rid of that speedometer because it hasn't changed in 20 years. So listen, what I said to you all in June is that we think inflation will continue to come down. By the way, we've been right about that. Why is the market sold off if we've been right about that? It's what
It's what happened last month. Inflation came in at 8.3. What expectation was at 8.1. By the way, we didn't think it was going to come in at 8.1. We thought it was going to be higher than 8.1 because the economy's too big to turn it that quickly. Okay. We think inflation continues to come down. Now, listen, that's a forward-looking statement. What if Russia, Ukraine, all of a sudden tomorrow, Russia nukes Ukraine, energy prices go to 130? That could happen. But what I'm saying is what we expect is that inflationary pressures continue to come down. The data that I showed you tonight supports that. Data can change. Data could change tonight. But we look at that data. We expect inflation to come down. Wage growth. Wage growth we expect to be sticky, right? You don't give your employees a 6.5% raise and then 7 months later go, hey, just joking. With as many job openings that there are, that will continue to create wage growth. Okay. Even though some companies have said, hey, we're not gonna, hire those new 5,000 people. We're gonna suspend that. Okay. That's why the 2 job openings for every unemployment dropped to 1.87 over the last quarter. Okay, that's fine because the Fed wants unemployment at 4. That's cooling of inflation in and of itself. But so point being is this: we expect inflation to slowly come down, and it is. Wage growth to slowly continue to go up, might plateau a little bit, might have inflation matriculate up a little bit, and blah, 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 blah. It's all data, kind of dependent. But as those 2 lines come closer to each other, and they are, 2 months ago, 9.1, inflation now 8.3, as those lines come close to each other, and eventually as they touch and as they cross, as they were over the last decade, stocks rebound greatly. If that happens, why? Goes back to the earnings. People have more money in their pocket than inflation. Those areas, okay, that they may have cut, consumer discretion. I use the ice cream store, right? They might not go up for ice cream, but they have the money in their pocket to do so. What happens inside of there is those energy costs, those material costs, food costs, so on and so forth. They all play a role. They're all coming down. We're clearly keeping an eye on it. There's a few other things that I'll say about that. One thing is the U.S. dollar is strengthening. The U.S. dollar is hugely up for the year. What in the world does that mean? That means that products abroad become less expensive. For a bunch of you inside the webinar tonight, you guys would call me and say, hey, the weak dollar, that's no good. I've been a proponent of a weak dollar since I was in college. And I say that to people and they think it's unpatriotic. And I say to them, well, when you have a very strong dollar, I remember back in like 1997, my sister went to the University of Melbourne. And I remember my dad saying to me, hey, you should go to the University of Melbourne too, because the dollar back then was so strong. So if you went to the University of Melbourne, tuition was half off because you had to buy Aussie dollars and you bought Aussie dollars with US dollars and you got 2 Aussie dollars for every 1 US dollar. However, when the US dollar is very, very strong, okay, it makes products much cheaper. What's wrong with that? It's inflationary. So that's kind of on our radar. You'll probably start reading about that somewhat in the headlines. And with the Fed raising interest rate, it makes the dollar strong. Why? Because people around the world, governments around the world want to deposit their money in America and get a higher interest rate. It's a whole nother discussion or presentation. By the way, we're done. But, we have our eye on that. We think inflation will continue to cool. Now, I also want to say it doesn't happen in a straight line. If you think about it, okay, inflation was expected at 8.1, it came at 8.3. Next month we get inflation, it comes in at 7.9. Maybe the month after that we get inflation, it comes in at 7.6 headline. But then maybe we go back up to 7.8. And wage growth, we kind of have wage growth. It'll probably flatten out a little bit. I think we uptick into the 4th quarter and then flatten out as we typically do because you have that seasonal help to get hired 4th quarter and fired 1st quarter. So you'll have a mixed bag of data. But if you go back and you look at the history books a year or 2 from now, those lines will look like, oh yeah, they just look like they move so smoothly. Not worried about the economic backdrop right now. We don't see unemployment, we don't see companies laying off massive amounts of people. Just not happening. And again, that's the core of everything. If we start getting data like that, by the way, that doesn't just happen overnight. You start getting little cracks inside of there, like people laying because there's no demand. Today, there's too much demand. That's why we have inflation, right? And so I'm not worried about the backdrop of the economy or earnings of companies right now. The market's forward looking. So the market's selling off right now because the market's going, hey, look, companies aren't going to earn as much, and you know, if they're not going to earn as much, then stock prices should go down. Today they're attractive. They're undervalued at a 15.51 versus the 25-year average at 16.8. So that's our 2 cents on things. I don't think this is an '08. We don't have massive amount of companies going out of business, right? Every bank in the world was going out of business in '08. This isn't 1999 where you had valuations at 123. Valuations are below where they are right now. We don't have a spike in commodity prices. Was worried about that if you go back and watch our first quarter video, right? At oil at 120, that, you know, hey, if it sticks up there, 66% increase, you know, just in the first 2 months of the year, that would have been a huge spike in commodity prices. We said, as we said back then, as the supply chain eases itself, commodity prices roll over. That happened. That happened, and it's happened. So it's not like other, you know, huge market sell-offs. Now, if it got there, I'm not a perpetual bull, even though if you look over my shoulder, you see a sign that says bullish. That just came in the mail today. Somebody sent it to me, and they sent it to me exactly because of what we're talking today. Down here, very bullish, buy low, sell high, right? But my point is, I'm not worried about this based upon historical huge market downturns and then a long recovery time. I think if the data keeps coming in the way it does, obviously there'll be some hiccups like we had in June with China closing, but markets will be just fine. Listen, again, I end this meeting by telling you this. I made forward-looking projections today. The forward-looking projections that I've made today are the same from the end of the year 2021 and every quarter that we've done these through 2022. Those forward-looking projections, at least for the first 9 months, have been right on. We kind of mapped this out saying, look, the supply chain will ease itself, inflation will come down. However, you know, markets will probably get a little bit more turbulent, and they have. And everything else that I said. So listen, I could talk for hours on this stuff. I thank you all. None of this should be, you know, construed as financial advice specific to you. Everybody's financial situation is different, and that needs to be taken into consideration. This is strictly for educational purposes. And listen, thank you so much for joining tonight. We appreciate you all. We thank you all. And please reach out to your Triumph Capital advisor. Should you have any questions, need a portfolio review, that type of thing, we're always here to help you. Thanks again, and have a wonderful night. I am signing off. Thank you.